Now, I always like to review this. I had a gentleman, one of our long-term subscribers, Mr. Mitch. Mitch called in this morning, and he's looking to do some covered calls right now, or maybe even sell calls. I think he's looking to sell naked calls, honestly. Not something I would do, but, Mitch has been around for years. He's doing different things. But he was looking at just selling calls. He might have been doing covered calls, but he was just using the long call search to do this. But let's just use the covered call search. But before we go into the covered call search, his question was, I'm looking for positions with a high implied volatility. Something with a high implied volatility. I want more bang for my buck. I don't know whether he's thinking that the market's going to stabilize or move down. It's going to hang where it is for a while. We saw the new inflation reports come out today too, not as helpful as we'd want them to be. But he asked me, what should I enter in the search tool for implied volatility? I want to see things that have what would be considered a high implied volatility, more bang for my buck. Okay, well, the first thing I wanted to tell him is that, there's two ways to look at that coin. And we're going to talk about that in a moment. But what is a high implied volatility right now? What is a low implied volatility right now? Well, you can see that at any time at PowerOptions. Underneath the main home tab, we're going to navigate over to the Learning Center. And under the Learning Center, you have some useful information here. The Quick Start Guide. You can schedule your coaching session. You can do that directly underneath the Home tab with the Free Coaching Session sub-tab. You can go to the Webinars view, Strategy Help page, Priority 1 Email Archive. That is a full archive of the Price Watch Alerts morning updates that you receive with the in-the-money covered calls. Ex-dividends this week, earnings this week, unusual option volume today report. And then there's market activity. Now, it is log on required, but we're already logged in. But I want to go to market activity. And here you have some of those other links again. Earnings, ex-dividends, stocks hitting new 52-week highs, 52 highs including non-optionable stocks, 52-week lows, market statistics, and optionable stock statistics. We click on optionable stock statistics, and this gives us a wide range of various metrics. The average stock price on all optionable stocks is $62.33. The high is $5,599, and the low is 2 cents. Something probably an over-the-counter or going into bankruptcy. So that's the average. The mean stock last price, the mean option last price is $12. Okay, but let's get into some other things. What is the current average price to earnings ratio, PEG ratio, price to book, price to sales, 10.5, extremely high. EPS, earnings per share growth, 33% is the average. Let's get into more fun stuff, shall we? SIV, implied volatility. 20-day volatility for the stock. The average 20-day, 50-day, 100-day is 48, 43, and 41. But the average implied volatility across all optionable stocks, yes, in the money and out of the money, I know that gets skewed, but the average implied volatility, far term, near term, is 0.91. So when Mitch asked me that question, said, what is a good implied volatility to use in my search to find more volatile options, which are giving me more bang for the buck? I said, well, here's the average right now. In the search tool, which we're going to look at, you might want to use a range of greater than 0.95, 0.90. So you're seeing things that are even or above the average across the entire market. Now that includes all expirations. If you're looking for what's near term, this is the SIV. The SIV is the stock's Implied Volatility Index. This is the average of the near term, I think less than 30 days, in the money and out of the money puts across all stocks. So if you're looking at a stock and you see that, I have an implied volatility of 0.57 and I have an SIV of 0.99, what's the difference? Your implied volatility is your implied volatility of your option, of course, is the implied volatility of your option. I'm sorry, but if you're looking at implied volatility average, it's across all expirations. This is just looking for the next 30 days in the money and out of the money calls and puts. So it's interesting. In the near term, the implied volatility, the SIV, is 25% higher, almost 30% higher than the average implied volatility across the entire market. All right. So this is a little bit interesting. So I had to tell him, if you're looking at 1 week out, 2 week out, or 3 week out trades, you might want to use this number as your base and look for an implied volatility of greater than 1.2, 1.3, somewhere in that range on your search to look for the higher implied volatility. Now let's go ahead and take a look at that. Let's go back here to our search. We're just going to use covered calls. We're going to go to the search. Just going to look at my last default there. And we were looking at the monthly picks of the day. Okay, so I have the IV-HV ratio and the IV over SIV. What I don't have is implied volatility direct for the option or the SIV for that underlying security. So let's go ahead and change the columns. I can add different stock criteria, but I want to just add, well, I'm going to add 3 things. Mark, yeah, I want to add 3 things. You know which one I'm going to do here. My apologies. I need to add straight implied volatility, which I did have, but I want to add SIV as well. There's IV over SIV. I don't have just the straight SIV, I think, on this view. I thought I did. It's on the option chain. I thought it was here. Black-Scholes ratio I could use as well. That's okay. We don't need to worry about that. But what I need, definitely, is the percent implied volatility range. We'll talk about that in just a moment as well. All right. Let's go ahead and submit and save and close the window. Oh, these are there. They're just in the other view. Okay. I apologize, folks. I'm going to adjust the columns. Bear with me 1 second. I'm going to change my column order. I want to see those 2 new columns. The percent IV range that I just added, I want that right next to the implied volatility. Yeah, so after the returns, we're going to have percent implied volatility range. We're going to put implied volatility above that. I'm not worried about IV, HIV, IV, SIV. We'll talk about that in a moment. And the implied volatility actual range is a little bit more important. We might not see that in our view because of the column headings, but I wanted to change that. There we go. Okay. So now I have my IV. But what did I say I wanted to do? I wanted to change this to the implied volatility of greater than 0.95. But if I'm going shorter term, under 30 days, if I'm looking for higher IVs, I might want to use that 1.25 as a minimum that I saw in the SIV. Let's filter all of those out. Now we've got some higher implied volatility positions here. I don't even know any. Array Technologies, I know. Applied Digital, I know. Celsius, I know. Riot, I know. Unity Software is probably not what I'm thinking of, but these first 2 I don't know. Current implied volatility, hey, we're at 1633. I'm going to sell the in-the-money September 14 call, midpoint of 390, 24% downside protection with a 12.6% if assigned if the stock stays above 14. My implied volatility is 1.7739. Probability of assignment is 65%. And I'm in the 60% implied volatility range. Marc says he used the ratio over historical for a particular stock I'm researching and looking for the higher value. And I'm going to talk about that in just a moment, but let me talk about these 2. You see some high numbers here, as I mentioned, on QURE, 1.7739 with a percent implied volatility range of 60. And TIGR, UP FinTech Holding, is at, let's just call it 1.9, shall we? Implied volatility, almost 200% implied volatility if you look at it that way. And this is at 100% implied volatility range. What's the difference between the 2? The percent implied volatility range is showing you where the option's implied volatility is now compared to where it has been over the life of the option. What one would consider as more of an overvalued option is something that's up in this 80 to 90 range. Celsius at 100. It's currently at the high of its IV range. So in addition to using a limited implied volatility value, I might also want to use that implied volatility range, percent implied volatility range of greater than 80. Now I've got to admit, we have to take this with a grain of salt. Sort of. So you've got these positions here, $9 stock array at 5, and 45% downside protection, 2% return with almost 100% probability. Always be wary of that. And we're at 81% of our implied volatility range at 1.665. Now, I mentioned that when I added those other columns that showed up here, what I wanted to look at is the actual implied volatility range. And this is great. And this one illustrates it pretty well. Since this option has been available on the market, the implied volatility has moved from 0.3556 to 1.9576. Again, we're at 1.655. So we're in the upper range of the implied volatility. But sometimes if I run a search and I look for a percent implied volatility range with some other metrics, I might see a covered call on, say, McDonald's in this case, or a bull put credit spread on McDonald's or Kraft Heinz, and it's showing me a 90% implied volatility range. The reason why I want this actual range here is because it might be at 90% now, but if the true range since this option has been released on the market and it's been out for 6 months is only 0.217 to 0.23, excuse me, and we're currently at 0.229 or 0.226, let's say. Well, that's not really near the high. It is near the high of its implied volatility range, but there's not much of an actual implied volatility range, is there? It's staying in this range. It's staying in those values. So that might not mean it means it's overvalued from where it has been, but it's not necessarily an overvalued option. Of course, using this other criteria of the implied volatility greater than 1.25 or the implied volatility of greater than 0.90, Kraft Heinz, McDonald's, IBM would never appear in that search. You'd never see it. But just screening for the implied volatility range, saying, hey, I want to see options that are near the highest of their IV range, meaning they're overvalued if the range is too tight. It's not really overvalued, is it? It's still equal valued. The other two sections here, the other two columns here, filters that we have, is what Marc's referring to. He said, I would use the ratio implied over historical for the particular stock I'm researching and looking for the higher value. And that's what this is. IV over HV, the current implied volatility of your option divided by the historical volatility of the stock. And as we saw, when we went back into that optionable stock statistics, what did we see? The average IV was around 0.91, but the average 50-day historical volatility was at 0.45. So almost every stock on average, but I mean, it's a 50% increase, almost 100% increase difference there between the 0.91, 0.95 implied volatility average across all expirations, versus looking at the 50-day historical volatility of the stock at 45 or 43. Yeah, they're all going to have an IV-HV ratio of 1, but that is a great point, Marc, and I usually use that too. This implies that your option is overvalued, as Marc mentioned, compared to the historical trading range of the stock. So an IV over HV is greater than 1.0, and my IV over SIV, as I mentioned, this is the implied volatility of your option divided by that SIV value, the near-term implied volatility average of your in-the-money and out-of-the-money calls and puts, and maybe I want that to be greater than 1 as well, maybe even greater than 1.1 for both. So IV over HV is your implied volatility of the option you're researching divided by the stock's historical volatility, 50-day volatility, if I'm not mistaken, and then the IV over SIV. What is your option's implied volatility compared to the average near-term 30-day out, whether it has weeklies or just standard 30-day out options? In the money and out of the money calls and puts, is your option overvalued compared to the average of those near-term options on the stock you're looking at? IV over SV is more of your option against the stock. Well, they both are. I apologize. Both of these are against the stock itself. The SIV is considered more of a stock indicator as well. And I submit the search, and it's the same three that we had after we put in that 80% implied volatility range. You still have Tigger, Array, and Celsius Holdings, but that other one, the QURE one, dropped out simply because it was 60. I'm sorry, folks. It was a 60% implied volatility range. Let's take that back down to 59. Because I want that QURE back in as well for our example. And it didn't come back in. I thought it was at 60. Maybe it's not. Oh, it might not be overvalued. Let me take these out again. I want the QURE position back in. Couldn't have changed. Let's go 50. Let me just take out the implied volatility range. Oh, I got to take this out too. Sorry, folks. I'm going back to that main search we used with just the implied volatility. There's QURE. Implied volatility range of 60. And we're at 1.7, so that came in. And the IV over SIV is, oh, the IV over SIV is only 1.05. That's what I was missing. It was 1.1. All right, so we were using that default of 1.1, meaning the implied volatility is of our option would be 10% higher than the average of the near term in the money and out of the money calls and puts for that particular security. IV over HV is strong, as we expected. And we saw those two averages. The average of the implied volatility was 0.91, 0.95, and the average of the 20-day and 50-day volatility is at 0.43. So yeah, we know some of these are going to be huge. And yeah, this is at 60% because its implied volatility range has moved from 0.5784 to 2.5813 since it's been released, and we're only at 1.77. So we're just at that 60% implied volatility range as well. All right. So using the optionable stock statistics, and this works if you're, looking for anything for some of the other features too, but IV is the most important one that I use there. IV, implied volatility range, IV over HV. You say, oh, well, what's the average delta that I should look for? Well, the average delta across the entire market and all expirations is going to be 0.50, right? Because the at the money is always 0.5, and you've got your in the monies, you got your out of the monies, they average out, and the average delta on that optional stock statistics page is always going to be around 0.5. But what is a good open interest? What's the average open interest across all stocks and securities? What's the average option volume today or previous option volume? That's in there too. You can use that as a gauge if you want to use those to measure your liquidity. But for implied volatility, using the mean, the average as a baseline, if you want to look for higher implied volatility positions, more bang for your buck, but by definition are going to take more risk. Something's going on with a lot of these stocks. Array, for example, there's something coming up in the near term that's causing that implied volatility to be high, whether it's earned. Let's take a look. I've got 9 results now with our 1.25 implied volatility, not using the implied volatility range of greater than 80, or the IVHV, IV, SIV that Marc mentioned. He's got some other comments we're going to share in just a moment. Let's bump this. Now, we're going to keep this here, but let's go to the fundamentals, shall we? For our stock fundamentals. Oh, I'm already using not between now and expiration. Great. So none of these have earnings between now and expiration. They're just highly volatile positions. But if I see a biotech here, the first thing I have to do is try to research, and I don't have a direct link for PowerOptions, but to research to find out what is going on. Is there a phase 2 or phase 3 drug trial coming out, which could cause the stock to move up 10, 15, 20, 25%, 30%, or could drop 80%? Is it worth it at that time, even with a 30, 40, 50% downside protection if the stock falls 80%? Maybe it's not worth it to play that. Marc adds, I just find that using this measure, remember we're talking about the IV over HIV, we want it to be, let's say, greater than 10%. I want the implied volatility of my option, selling-wise, to be higher than the recent historical trading volatility of the stock itself. I'm looking for at least 10% or more. And that cut us down to the 9, we're still in the 9 results there. Marc says, I find that using this measure, a lot of calls are overpriced on the American market. I can get higher prices on the European option markets. Okay. It's as if a lot of investors on U.S. markets are threatening buying calls as buying lottery tickets. And you're not wrong. I don't necessarily want to say a lot. But Marc, I agree with you. I think there was a lot of speculation, a lot of FOMO, fear of missing out. I don't like using that term too much, but we used it in some of our webinars in the past. And new investors, and we've seen, some of the options tradings that have been done by some of our government officials over the last 4 or 5 years, right? There was the whole Pelosi trade, and then there was, they're following one of the other Republican ones with the options trades and things of that nature. Millions of dollars putting in call options, put options. We don't even know if they were spreads or not. Most of them didn't seem they were. They were speculating on calls and puts with knowledge that they had, or we want to project that they had, but maybe they didn't have. And so on and so forth. But Marc's comment about the speculation using calls as lottery tickets, I got to be honest with you guys, that's how I use long calls myself and long puts. Long calls and long puts solely without in the form of a spread position or as part of another options trade, represent probably only 3 to 5% of my total portfolio. To me, it is a lottery ticket. Hey, I like this stock. Sometimes in a married put and I'm looking and I'm seeing the stock, I just rolled down income method number 9 and I'm seeing a change and I'm going to roll up because the MACD went positive. I might take 1 or 2% of my portfolio and buy an extra call or two on that trade. For what purpose? Hey, it makes 50 to 60%. My married put gets back to break even. I make 70, 80%, 60% on that very small trade. I can take my wife and my girl out to dinner. That's it. So Mark says, this is what makes me happy as a call seller. And I get that, Mark. I get that. There are some overpriced in there. There's the fear of missing out. You see it anytime there's news that comes out on NVIDIA, on Tesla, on AMD. You start to see the volumes of the calls go wild and the wide bid-ask spreads start to appear. And if you pick the right price as a seller, you can make out. If you get the right timing as a buyer, you can make out. And it's not just a wash. It comes down to timing and it comes down to management of those positions as well, Mark. But I get what you're saying. And this is what we're looking at here. The implied volatility. What is the standard? Looking for the overprice, but making sure it's higher than the historical volatility of stock. And you can use the implied volatility range as well. And of course, we have some more detailed information on that for you. Let me go back to Power Options first. Let me go into the free webinars section. We had a couple of these webinars recently. And I think I want to go to options concepts and what does implied volatility imply? There was a discussion there where we went further into the definition of implied volatility, Black-Scholes theoretical pricing model, implied volatility, IV over HV, look at IV and on GAP, analyzing it as we just did with the ups and downs and so forth. And let's see here. Let me just go to your YouTube channel. So that's one that I like that because it goes through it more in depth. It's more of a beginner one, but it goes into a little bit more detail. I'm going to search across our channel here for high volatility. We did a discussion this year, I know, or maybe it was at the end of last year, where we actually did. So high implied volatility mean the stocks that's from 4 years ago. This isn't ordered by years. Screening for high or increasing IV on bull put credit spreads. Strategies for low volatility markets, that one not what we're talking about. Old one, implied volatility, the double-edged sword, I'd probably remake that one. Sell into high IV, buy into low. It's from 4 years ago. There was something from a few months ago. It was an IV search. Let me do IV. Let me do high IV instead. Sorry, folks. Searching for high implied volatility cash secured puts. This is the one I was thinking of. It was a similar thing. We walked through, the catch-22 of high IV trades was from Raphael saying he wanted to sell out of the money cash secured puts with a higher implied volatility, the higher implied volatility range that were overvalued. And we walked through how to do that just as we did. What settings would we use? 26 minutes or so, 27 minutes almost, 26 and a half minutes. But we walked through that same thing. What was at that time, 3 months ago? What was the average implied volatility and historical volatility on that optional stock statistics page? How would we incorporate that into our search? And if I'm not mistaken on this one, we even walked through some back test over the last two. Whoop, sorry, folks. There we go. Talked about the catch-22 of implied volatility, the market statistics using those values. And why did those stocks filter come in? Oh, it was because of earnings. And I think I'll have to check this out for you guys, but I think later on what we did is we actually back tested that over, I can't remember if he was using weeklies or monthlies, but I think we tested it over a 4-period cycle with the settings that we created to see how it performed. And it performed as you expected. A lot of losses came up pretty big. Wins came up pretty big because the high IV, and it came out to be about a wash. Now, that does not the market make. Mark, I've talked to Mark on various occasions over the years. He's given us insight, ideas, suggestions, questions, and so forth. So he's looking for high IV trades that have the implied volatility over the historical volatility, looking for things that are overvalued and selling options in different phases. And he's been doing well because he's still with us and he's still here with us on our presentation. So that can work. But sometimes looking for too high of an IV can get you into too much trouble. You got to see why the implied volatility is so high. And some of those presentations I mentioned there with the, we talked about with the Implied volatility, the double-edged sword. Does the high implied volatility mean the stock is going up? Opposite for low volatility? No, it does not. Screening for high or increasing IV, that was from 3 years ago. But the double-edged sword of why does it have a high implied volatility? It's because there's inherent risk in that trade, whether there's something in the news, some expectations coming out, whether it's a gas company that's waiting to hear about a lease in a foreign country for land to do more drilling, of course, and do more production. If they get it, great. If they don't, meh, stock falls. So you gotta take that into account as well. Okay. And Marc says, of course, also covered calls within the married put structure, of course. So we look to, I do too. When I'm doing my income method number ones, I usually want to make sure that the option is considered overhead. Sometimes after a drop, if I roll down the put, that's a great time to sell a call. Combination of income method number 9 and income method number 1 that are discussed in the blueprint to get that extra bang for the buck, Marc.